Listen up. The strategy helps you find trades, but risk management is what keeps you alive long enough to actually learn. Today, we are going to learn how to trade for months or years without ever blowing up your account. First, let's look back at the setup formula we built in part 7. Remember, we need an edge before we risk a dime. Once you have that set up, the next question is always, how much should I actually buy? Here is the golden rule for beginners. While you are learning, you should only risk 0.5% to 1% of your account per trade. This might seem small, but it is the secret to staying in the game through the ups and downs. Let's look at an example. If you have a $1,000 account, risking 1% means you lose $10 max if the trade fails. $10, that's it. It's manageable, it's controlled, and it won't ruin your week. Now imagine your trade setup has an entry at 1.0850 and a stop loss at 1.0800. That is a 50 pip distance. This distance is vital for calculating our next step. The most common mistake is picking a lot size first. Do not do that. The math defines the lot size. Your lot size must be set so that a 50 pip loss equals exactly $10. Here is the correct order of thinking. Step 1. What is your current account balance? Step 2. Decide your risk percentage. We're sticking with 1% today. Step 3. Calculate that into dollars. For us, that's $10. Step 4. Measure your stop distance from your entry point in pips. Only now, at step 5, do you determine your lot size using those numbers. Let's talk about 1R. This is simply the unit of risk you have decided on for the trade. In our example, 1R equals $10. It is the baseline for everything that follows. A standard target is 2R. That means if you risk $10, you are aiming to win $20. This is called a 2-to-1 reward to risk ratio, and it is the key to long-term profitability. You do not need to be right all the time. In fact, you can lose half your trades and still make money. The goal is to make sure your winners are significantly bigger than your losers. It's all about the sample size. Look at this sequence. You lose $10, then you lose another $10. Don't panic yet. Then you win 20, win another 20, and lose 10. Even with 3 losses and 2 wins, you are up. You ended with a $10 profit. That is the power of a solid reward to risk ratio. Crucial rule, never ever widen your stop loss after you enter a trade. Accept the loss. Widening a stop is just hoping, and hope is not a strategy. Stick to your original plan. Another safety net, if you hit 2 full stop losses in a single day, you are done trading until tomorrow. This prevents emotion from taking over and protects your capital when the market is acting up. Avoid revenge trading. Do not try to win back what you lost by doubling down on your next position. An oversized recovery trade is the fastest way to blow up your account. Stay calm and stay disciplined. Always remember the spread and potential slippage. These small costs add up and can affect your math. Factor them into your calculations so you aren't surprised when the actual numbers vary slightly. You should use a risk calculator. Enter your account balance and your desired risk percentage. Plug in your stop pips and it will tell you exactly what lot size to use. It takes the guesswork out. Time for a quick quiz. If you have a $500 account and risk 1%, what is your max loss? The answer is $5. If you said 5, you're tracking perfectly with the math. Next one, $2,000 account at 0.5% risk. What is the max dollar loss? It is $10. Remember, 0.5% is half of 1%. Great job. Here is your mini assignment. Calculate the risk in dollars for these 3 account balances. Calculate them for both 0.5% and 1%. And remember, no live trading yet. You're doing great. Mastering risk is the hardest part of trading, and you've just taken a huge step. In part 9, we will show you how to place an actual demo order with entry, stop loss, and take profit. See you then.